Hello, everyone. Welcome to our weekly lecture videos. This week, our topic is net present value and other investment criteria, and we are covering Chapter 8 this week. This chapter introduces you to the practice of capital budgeting. If you recall, in Chapter 1, we saw that increasing the value of the company's shares is the goal of financial management. Thus, what we need to learn is how techniques that are actually used in practice. Okay, so more importantly, it shows how many of these techniques can be misleading, and we will explain why the net present value approach is the right one. Okay, so in Chapter 1, we also identified the 3 key areas of concern to the financial manager, and one of them was capital budgeting. Okay, if you can remember, capital budgeting decision. So it also called investment decision. So in this chapter, we begin to deal with the issues that arise in answering these questions. Okay. The process of allocating or budgeting capital is usually more involved than just deciding whether or not to buy a particular fixed asset or start a new project. We will frequently face broader issues, such as whether we should launch a new product or enter a new market. Decisions such as these will determine the nature of a firm's operations and products for years to come, primarily because fixed asset investments are generally long-lived and not easily reversed once they are made. For this reason, the capital budgeting question is probably the most important issues in corporate finance. How a firm chooses to finance its operation are certainly issues of concern, but it is the long-term assets that define the business of a firm. Okay, airlines, for example, are airlines because they operate aircraft, regardless of how they finance them, right? So any firm possesses a huge number of possible investments, and each possible investment is an option available to the firm. Some options are valuable, some are not. Okay, so the essence of successful financial management, of course, is learning to identify which are which. With these in mind, our goal in this chapter is to learn the techniques used to analyze potential business ventures to decide which are worth undertaking. Okay. So as usual, there are several learning objectives in this chapter, and I will be uploading one lecture video for each of these. And this is the first video of this chapter where I will explain the net present value and payback rule. We will discuss about net present value later in one of the learning objectives. Okay, so first of all, when we are to decide whether an investment is a value-adding investment or not, we need to use a decision criteria. Okay, so for example, net present value or payback rule, these are some decision criteria. Now, there are some characteristics of this decision criteria that make a decision criteria good or bad. For example, does this decision rule adjust for time value of money? So a good investment evaluation decision criteria should adjust the time value of money. Does the decision rule adjust for risk? It also should adjust for risk. And does the decision rule provide information on whether we are creating value for the firm? Okay, so if a decision criteria answers to these questions are positive, then we will say that it's a good investment evaluation technique. Okay, so let's proceed. First of all is net present value. Look, the basic idea of evaluating an investment is that an investment is worth undertaking if it creates value for its owners, right? So in the most general sense, we create value by identifying an investment which is worth more in the marketplace than its cost to acquire, okay? So if I repeat, an investment will add value if its value is higher or its worth is more than its cost. Okay, so for this reason, the first investment evaluation technique that we consider here is net present value. So net present value is the difference between an investment's market value and its cost. And the reason it is called net present value because we consider its value and cost, and the difference between value and cost is the net present value. Okay, so the net present value essentially measures how much value is created in present value terms by undertaking an investment. Like we make an investment, how much value is created, and with this value is calculated as the present value. Given our goal of creating value for shareholders, the capital budgeting process can be viewed as a search for investment with positive net present value. Okay, so you know that the ultimate goal of a company is to maximize shareholders' value. That's why an investment project with a positive net present value should be accepted, as it will add value to the company. Positive net present value means that its value is higher than its cost. Okay. Now, net present value technique is also called discounted cash flow technique. The reason it is called discounted cash flow technique because we actually calculate the present value of the future cash flows, and you know the process of finding out present value is called discounting. Okay, so that's why it is called discounted cash flow techniques. So there are 3 steps of implementing this decision rule. First of all, as far as a project is concerned, we estimate future cash flows. Okay, we estimate future cash flows, and then we estimate a required rate of return of the project. So required rate of return means the rate of return that we want to earn for this investment or for this risk level investment. Okay, so that is the required rate of return. So once we have estimated cash flows, once we have the required rate of return, then we find out the present value of the cash flows. Okay, so present value of the cash flows, you can see this is the present value of the cash flows, and we deduct initial investment. So you see the cash flow 0, this is initial investment, and this is the present value of the cash inflows. Okay, so we call it net present value because it is a difference between the present value of cash inflows and the initial investment or outflow. Okay, and I already have mentioned that a project with a positive net present value should be a value additive project because its cash inflows, present value of cash inflows are higher than outflows. Okay, now I understand you might have question in your mind that how do we estimate future cash flows? How do we estimate required rate of return? So this cash flow estimation and required rate of return estimation, we will discuss them more detail in future weeks. Okay. So in this week, we mostly concentrate on calculating the net present value or implementing this decision criteria and decide that whether a project should be accepted or rejected. Okay, so as I already mentioned, that net present value essentially is a measure of the value addition to the company. Okay, so that's why if NPV is positive, we accept the project because its value is more than its cost, so it adds value to the company. So NPV 0 means we will be indifferent in accepting or rejecting the project because its inflows are just sufficient to repay its initial investment. So it doesn't, essentially, it doesn't add any value. It doesn't destroy any value, but it doesn't even add anything. Okay. So look at this example. We expect that the cash flows over the 5-year life of the project will be $2,000 in the first 2 years, $4,000 in the next 2 years, and $5,000 in the last year. Its cost is about $10,000, and we use a 10% discount rate. Okay. So we will find out the present value. How do we do that? Theoretically, as I explained, that we will find out the present value of this cash inflows, am I right? And we will deduct this initial investment. Okay, so you can see this is the present value of cash inflows. First year, second year, third year, fourth year, and fifth year, and we deduct this initial investment. You can see the negative sign in front of $10,000 because this is cash outflow, this is investment outlet. Okay, and we see that our net present value, that means if we find out the present value of inflows, deduct the initial investment, we see that net present value is 2,313. So as I already mentioned, that a positive NPV project should be accepted because it is worth more than its cost. So since the NPV of this project is positive, we should accept this project. And if a project's NPV is negative, we should reject the project. Okay. Sorry. Okay, now how good an NPV method in terms of project evaluation? NPV is considered to be the best method in evaluating an investment project because of these points. First of all, it considers all cash flows. So you see that it considers from initial investment to all cash inflows. And it also considers time value of money. So you remember that we calculated the present value of the cash flows because you know that $100 today and $100 after 5 years are not the same. That's why we must decide about a project investment considering time value of money. It adjusts for risk. Now, we will discuss this point later, more detail in one of the future weeks. It adjusts for risk because it adjusts in terms of discounting. And you remember that, for example, in the previous case, we have seen that we discount the cash flows using a discount rate of 10%. So that 10% essentially is a required rate of return. That means the rate of return that you want to earn from this risk class investment. Now, if your required rate of return is higher because a project is more risky, then your discount rate will also be higher. That means instead of 10%, that might be 12% or 15%. If you think that the project is more risky and you should be compensated for that. So required rate of return will be higher. On the other hand, if a project is less risky, you are happy with a lower return, then your required rate of return will also be lower. Okay, so you see that this is how it adjusts the risk. NPV also can be used to rank mutually exclusive projects. Mutually exclusive projects means when you have more than one project, but you have to choose one of them. In that case, these projects can be ranked on the basis of NPV, and we should choose the one with the highest NPV because that's the project that adds maximum value to the company. So since the NPV method meets all these desirable criteria, so NPV is considered to be the best investment evaluation technique. Okay, so it is, as I mentioned, it is a dominant method, and it also directly relates to the increase in farm value. Okay. We will discuss more detail about NPV, its superiority, its comparison with other investment evaluation technique in one of the future learning objectives. Okay, now another investment decision criteria is the payback period. Okay, it is common in practice to talk of the payback on a proposed investment, right? So payback means that if we are investing, how long we will take to recover our investment, okay? So that's a payback. So loosely, payback is the length of time it takes to recover our investment or get our investment back. So because of this, it is often called the payback period, okay? So this idea is widely understood. It is simple. And that's why let's talk a little about this. So how do we compute the payback period? Now, first of all, as usual, we estimate the cash flows, estimate the future cash inflows from a project, and we look at the initial investment, and we find that how long it takes to recover this initial investment using the cash inflows of the project. Okay, and the decision rule is the firms usually will have a predetermined maximum acceptable payback. And if calculated payback of a project is higher than this maximum acceptable, if the payback period of a project is less than this maximum acceptable payback, then a project will be accepted. On the other hand, if the payback period of a project is higher than the maximum acceptable payback, then the project will be rejected. Okay. So look at this example. This project has a cash flow of this $100, $200, and $500, whereas its initial investment, the project cost is $500. Okay, now let's see how long it takes to recover its investment. So you see that its initial investment is 500. So 100 is recovered year one, 200 is recovered in year two, 500 is recovered in year three, which means that in third year, our entire investment is recovered. So payback period of this project is 3 years. Okay, 3 years, which means that within 3 years, all the investment will be recovered. Now, as I mentioned that how these will be accepted or rejected, and I said that a firm has a maximum acceptable payback. Now, let's say a company has a maximum acceptable payback of 4 years. Okay, which means that the company wants to recover all its investment within 4 years. Now, our calculated payback of this project is 3 years. So this project will be accepted. Why? Because the payback is less than the maximum acceptable payback. However, if you calculate the payback for a project and it is 5 years, then that project will be rejected. Why? Because the maximum acceptable payback is 4 years. So the company wants to recover its investment within 4 years, but that project will need 5 years to recover its investment. That's why that project will be rejected. Okay. So although roughly 3 years is the payback period, you can see if you calculate exactly, it is 2.4 years. Okay. Now let's see what are the advantages and disadvantages of payback. First advantage is it is easy to understand. Okay, easy to understand. You see that it's theoretically it's very easy. Your investment, you have cash inflows, how long it takes to recover this investment. Okay, it's just for uncertainty of later cash flows, and it also bias towards liquidity because we see that how quickly we recover our investment. Okay. Disadvantages are it ignores the time value of money. You see that we didn't calculate the present value of the cash flows. Rather, we compared directly the absolute cash flows. It doesn't consider time value of money. Okay. So that's the main disadvantage because you are investing $500 today and you recover this $500 over 5 years. The value will not be the same, right? And requires an arbitrary cutoff point. As I said, that a company will have a maximum acceptable payback, and this maximum acceptable payback is arbitrarily set by management. Okay, now that might change based on the management. Sometimes it could be 3 year, 4 year, 5 year or so. Okay, and as it changes, then some projects may become acceptable or unacceptable. It also ignores the cash flow beyond the cutoff point. Okay, so you see that payback period is the time period when initial investment is recovered. Now a project may continue beyond that point, and the cash flow beyond that point doesn't have any impact on our acceptance or rejection of a project. Okay. And bias against long-term projects, because you see that since we are looking at how quickly we recover our initial investment, so long-term projects will usually be less attractive because it takes long time to recover our investment. Okay, so due to these disadvantages, so payback is theoretically is not a very sound technique. However, payback is still used because of its easy to calculate and easy to understand. Okay, so that's the end of this video where we have learned about net present value and payback method.